I'm Tom Anichini, Chief Investment Strategist at Guided Choice. I'm a CFA charter holder and a CFP certificate, and this is Trekking Through Retirement. Gift taxes. They're different from income taxes, and it might surprise you to hear that gift taxes are not paid by someone who receives a gift. So let me explain. You've probably heard of estate taxes. Those are taxes on the estate when someone passes. The U.S. Treasury has a unified wealth transfer tax system. And by unified, I mean they unify the taxes that apply to property that is transferred while alive and property that's transferred at death. And from a policy perspective, they don't really care when you transfer your assets. They just want to make sure they get their due in terms of taxes. So the gift taxes and estate taxes all come together when your estate gets settled. There is an annual exclusion amount. There's also a lifetime exemption amount. These are key numbers to understand, and I'm going to get to them in a few minutes. But the important thing is that when you as a person give a gift to another person and it exceeds the threshold of the annual exclusion amount, that is a taxable gift, and you will have to file a form with the IRS to let them know about that taxable gift. And the excess of the value of the gift over the exclusion amount is where the gift tax might come in. And I say might because we won't know for a while. So let's keep going. What is a gift tax? Well, the purpose of a gift tax is to avoid estate tax avoidance. So there was an estate tax, and if people thought, I'm not going to pay the estate tax, I'll just give gifts away to people while I'm still alive. Well, the Treasury Department already figured that one out, and they said, no, we've got this gift tax system, and if you give away gifts that are substantial enough, we're going to tax those too, maybe. And so the tax is actually on excess gifts. And the examples of the types of gifts include cash, if you sell property to someone for less than its value. The amount below its value is tantamount to a gift. Also, if you forgive a loan, the principal forgiveness, that can be regarded as a gift. If you give a loan and don't charge a high enough interest rate, depending on how much the interest could have been, that might be a taxable gift. In any case, there are annual thresholds to this, so let's dig a little bit deeper. I've mentioned a few times there is this annual exclusion amount, and in 2024, that annual exclusion amount is $18,000. If you give someone a gift in excess of $18,000, you will have to file Form 709 in 2024. And the amount of your gift above $18,000 might be subject to gift tax down the road when your estate is settled. One way to get around this is to spread your gifts over time such that you give it in different years, always keeping below the exclusion amount. Another way is if you are married, you can give some and your spouse can give some because you have two independent exclusion amounts. So if I wanted to give $20,000, I could give 15 and my wife could give 5. Now they're both under the exclusion amount. We give them to the same recipient, and neither one of us has to file Form 709 for gifts to that recipient. By the way, you can give gifts to multiple recipients, and it doesn't matter what they add up to. It only matters that each one is below the exclusion amount. If they're above the exclusion amount, you got to file Form 709. Now, I've hinted at taxes possibly being paid down the road. There is a lifetime exemption amount. And presently, that lifetime exemption amount is going to be a little bit in excess of $13 million in 2024. And if you were to pass in 2024, your estate could be worth as much as that lifetime exemption amount, and there'll be no estate tax. However, if you ever filed Form 709 and you had those little increments on which you owed gift tax, well, those little increments get subtracted from your lifetime exemption amount. So it's possible that if you were to pass in 2024, your lifetime exemption amount might drop from 13 million to 12 million. Now your lifetime exemption amount is a little bit lower. So the gift taxes accrue to spend part of your lifetime exemption amount. Now our system is very much encouraging of married couples, so you have an unlimited ability to give gifts to your spouse, provided your spouse is a U.S. citizen every single year. There's no annual exclusion amount. If your spouse is not a U.S. citizen, there is a limit on how much you can give your spouse, and that limit might ratchet up with inflation. But it's much higher than the $18,000 or so in 2024. I believe it's in excess of $100,000. Some other special exclusions: you can give away as much as you like to qualified charitable institutions. There are also some other types of gifts that you can give away. There are also ways to give gifts that benefit people in such a way that don't require a Form 709, regardless of the amount. I'll talk about those shortly. One final thing: when you pass, your unused lifetime exemption amount gets tacked on to your spouse's. So if I were to pass in 2024, my 13 million plus lifetime exemption amount would be tacked on to my wife's. So hers would become 26 million and change, or maybe 27 million, depending on what the rounding is. Something to consider, though, is that just as tax laws change, these exemption amounts and these exclusion amounts are subject to revision. And right now, that lifetime exemption amount is a result of the 2017 Tax Cuts and Jobs Act. And it is scheduled to sunset in a few years. So without any kind of legislative action, the lifetime exemption amount might fall back to the trajectory it previously was on. So keep apprised of that. Let's talk about filing gift taxes. I've mentioned Form 709 a few times. When you file Form 709, you file it at the same time you'd file your ordinary income tax, which typically is mid-April. It is the donor's responsibility to file, not the recipient's. The recipient has no tax burden, no filing burden. Let's talk about some common gift tax scenarios. I'm going to talk about education situations, medical situations, and below market sales of property. So, first, with education. If you gave someone money to pay their tuition in 2024 and their tuition were $30,000, we know the 2024 annual exclusion amount is $18,000. So my understanding is that you would have to file Form 709 with a taxable gift of the excess, $12,000. That would be considered when your estate gets settled, and possibly resulting in your estate paying estate tax. If there's medical debt and you want to help someone out and you gave them money, similarly, if you gave them an amount above the exclusion threshold, that would require you to file Form 709 as a taxable gift. Note, if you ever paid attention to the levels of 529 plan contributions, those are considered gifts. That's why the threshold for a 529 plan is set where it is. It's typically set at the annual exclusion threshold. 529s are a little bit different in that you're permitted to pre-fund several years' worth of gifts in a 529 plan, but it's a bit of digression for the gift tax topic. What if you were to sell someone property at an obviously below market sales price? That could be a taxable gift if the difference between the price you were paid and the price it was really worth exceeds the annual exclusion amount. You'll probably have to file Form 709 with that amount as a taxable gift. What are some strategies? Well, you give the money directly to the institution of higher learning. So instead of giving someone money for tuition, you just pay the university and say, I'm paying the tuition for so-and-so. There's no requirement to file Form 709. Similarly, if someone owes medical debt to a hospital, you pay the hospital and you say, I'm paying the medical debt of so-and-so. There's no Form 709 regardless of the amount. Another possibility, I touched on this earlier, is a joint gift by spouses. So in 2024, the annual exclusion amount is $18,000. Implicitly, for a couple, it's $36,000. So you can both give the same recipient up to the exclusion amount without having to file a Form 709. So for planning, for estate planning, first of all, you're going to want to document. You're going to want to document to whom you gave what and when, what the value was, etc. Keep receipts. You can talk to an estate planner and set up special types of trusts that entail periodic giving. There are life insurance trusts. There are trusts that entail giving to the next generation. Those can have their own problems. You should really talk to an estate planner or a tax consultant about those. Takeaways: file gift tax forms now, pay gift and estate tax at death. I think you understand the importance of the annual exclusion and lifetime exemption amounts, and make sure you document everything and consult an estate planning professional.